Picture this. You wake up one Monday morning. Your life savings? Gone. Your retirement account? Wiped out. Your home? The bank's about to take it. Now imagine this happening to 10 million Americans, all at once in a single day. Sound like a nightmare? It's not. It's history. September 15th, 2008, the day Lehman Brothers died and took the American dream down with it. The fall of Lehman Brothers. How one weekend destroyed everything. Just one weekend. That's all it took to obliterate a 158-year-old empire. On that fateful Monday morning, September 15th, 2008, the world opened its eyes to the unthinkable. Lehman Brothers was gone. America's fourth biggest investment bank had just declared bankruptcy. The biggest bankruptcy in U.S. history. We're talking about more than $600 billion in assets and $619 billion in debt. And then, chaos. Within hours, global markets went into cardiac arrest. The Dow Jones dropped 500 points in a single day. Credit markets? Completely frozen. What everyone thought was just a housing hiccup had turned into a full-blown global financial heart attack. But here's the thing nobody wants to admit. Lehman's collapse wasn't some freak accident. It wasn't a bolt from the blue. It wasn't even a surprise, not really. This was the inevitable explosion of a system that had been rewired for one thing: greed. A system where the profits were private, the risks were dumped on all of us. And reality? Reality was just a suggestion. Every empire collapses the same way. Slowly at first, then all at once. And this one? It started crumbling long before 2008. The beginning. 3 brothers and a dream. The story starts in 1850 in Montgomery, Alabama. 3 German Jewish immigrant brothers, Henry, Emmanuel, and Mayer, arrived with nothing but ambition. They began trading cotton, helping Southern farmers connect with Europe's hungry textile mills. Over the decades, they grew. From trading cotton to financing it, from commodities to railroads, from railroads to manufacturing. Eventually, they became one of the pillars holding up Wall Street itself. Lehman Brothers survived the Civil War, 2 world wars, the Great Depression. They helped finance the steel, the retail stores, the airlines, the industries that built modern America. By the post-war boom years, Lehman had earned something rare on Wall Street: respect. They were conservative, discreet, a family business that valued reputation over recklessness. Then the 1980s hit, and everything changed. The transformation, when greed became gospel. The Reagan era unleashed something new on Wall Street: the cult of deregulation. Glass-Steagall, the law that had kept boring banks separate from risky gambling since the Great Depression, started getting torn apart piece by piece. Suddenly, debt wasn't the enemy anymore. It was a tool. Leverage became the new religion on Wall Street. The prayer went like this: borrow cheap, buy big, ride it to the moon. In this brave new world, Lehman Brothers was reborn, not as a banker anymore, as a gambler. They bet on real estate, on bonds, on derivatives, on anything that could be packaged up, slapped with a price tag, and sold to the next guy. Wall Street wasn't in the business of funding real companies that made real things anymore. No. Now, it existed to create financial products that made money from money. Money eating money. By the early 2000s, this madness reached its final form: mortgage-backed securities. The con: turning garbage into gold. On paper, the idea sounded genius. Take thousands of home loans, bundle them together into one big product, slice it up, sell pieces to investors all over the world, spread the risk around. Easy money. It was financial alchemy, turning debt into gold. Except the gold was fake, completely counterfeit. Banks started handing out mortgages like candy on Halloween. No income, no job, no assets, no problem. Sign here. The loans were trash, but who cared? They'd get bundled up, stamped with a shiny AAA rating by credit agencies and sold to pension funds and insurance companies as safe investments. It was a pyramid scheme wearing a three-piece suit. And Lehman Brothers? They were one of the architects. By 2007, Lehman had morphed into a real estate monster. They were sitting on over $600 billion in assets. Sounds impressive, right? Except they only had $22 billion of their own money. That's a leverage ratio of almost 30-1. For every single dollar they actually owned, they'd borrowed 30 more. That's not investing. That's not even gambling. That's financial suicide with a smile. But Wall Street didn't care. Stock prices kept climbing, bonuses kept flowing like champagne, and the illusion? The illusion kept growing bigger and bigger. Wall Street had stopped measuring risk. Now they were just selling it to suckers.
The man at the helm, Dick Fuld.
And at the top of Lehman Brothers sat a man who perfectly embodied the arrogance of that entire era. Richard Dick Fuld. Cold as ice, combative, fiercely protective of the Lehman name, Fuld believed in one thing: domination. Not cooperation, not caution, domination. Under his watch, Lehman's risk exposure shot through the roof, but so did his paycheck. Between 2000 and 2008, Dick Fuld personally pocketed roughly $480 million, almost $500 million, even as the company rotted from within. When analysts started warning that the housing bubble was about to pop, Fuld waved them away. When Bear Stearns collapsed earlier that year, he insisted Lehman was different, stronger, better. When investors started running for the exits, he blamed conspiracy theories and short sellers. But math doesn't care about your ego. The housing market was collapsing. Mortgage securities were becoming worthless. Lehman's debt now outweighed everything they owned. Every hour that passed, billions were getting erased from their books. The final weekend, when Washington said no. By September 2008, the U.S. government had already jumped in to save Bear Stearns with a little help from J.P. Morgan Chase. They'd quietly bailed out Fannie Mae and Freddie Mac, the twin giants propping up America's entire mortgage market. Lehman expected the same treatment: a bailout, a buyer, something. But this time, Washington said no. Treasury Secretary Henry Paulson, former CEO of Goldman Sachs, mind you, declared that the age of bailouts was over. No more rescues, he told Congress. The argument: saving every reckless bank creates moral hazard. If you never let the guilty fail, they'll never stop gambling with other people's money. So on Friday, September 12th, 2008, government officials and Wall Street bankers crammed into the New York Fed to try and broker a deal. Barclays showed some interest in buying Lehman, but British regulators refused to guarantee Lehman's massive toxic losses. Nobody else stepped up. By Sunday night, the verdict came down. Lehman Brothers would be allowed to die. Paulson and Bernanke believed the financial system could handle the shock. They thought they had it under control. They were catastrophically wrong. When Lehman filed for bankruptcy at 1:45 a.m. on Monday, September 15, 2008, the entire financial world imploded in real time.
The implosion, when trust evaporated.
Within hours of Lehman's bankruptcy filing, the global credit system froze solid. Interbank lending, the invisible plumbing that keeps money flowing between financial institutions, dried up overnight. Banks stopped trusting each other. They had no idea who was next. Who else was hiding toxic garbage on their balance sheets? Trillions in short-term loans just vanished. Even rock-solid companies suddenly couldn't roll over their debts. The panic didn't stay on Wall Street. It jumped oceans in minutes. London trading desks emptied. Tokyo's markets went haywire. Frankfurt scrambled to figure out their U.S. exposure. Within a week, every major economy on Earth was staring at the same screens, watching the same thing: red numbers falling fast. But to really understand how catastrophic this was, you need to see how fragile everything already was before Lehman fell. The house of cards. Everyone was playing Russian roulette. Lehman wasn't the exception. They were the rule. Every major investment bank had done the exact same thing, borrowed short-term money to buy long-term, impossible-to-sell assets. As long as housing prices went up, the machine printed wealth. The second they fell, leverage turned profits into landmines. Lehman had leveraged itself 30-1, but Merrill Lynch was at 27-1. Morgan Stanley, 32-1. The entire financial system was a skyscraper made of borrowed glass, and Lehman was just the first window to shatter. So when Lehman collapsed, the illusion of safety collapsed with it. Investors fled to cash. Money market funds, supposedly as safe as a savings account, started breaking the buck, falling below $1. That terrified ordinary Americans, because if even your safe money could evaporate overnight, what was safe anymore? Governments tried to calm people down publicly. Behind closed doors, they were panicking. The Federal Reserve started pumping hundreds of billions of dollars in emergency cash into the system, buying up toxic assets nobody else would touch. And that's when the true hypocrisy revealed itself.
The betrayal. Selective salvation.
Because after letting Lehman collapse, the government bailed out everyone else. AIG got $182 billion. Goldman Sachs and Morgan Stanley were instantly reclassified as bank holding companies, a cute little loophole that gave them access to Federal Reserve emergency money. Citigroup and Bank of America got handed billions of taxpayer cash. The same week, Lehman's employees lost everything: their jobs, their savings, their futures. Wall Street's most powerful firms got a blank check. It wasn't about principle, it was about power. Lehman didn't have the right friends in the right places. Goldman Sachs did. That decision, letting one bank die while saving all the rest, turned a crisis into a catastrophe. Trillions of dollars in market value disappeared. Millions of jobs vanished. Over 10 million Americans lost their homes. The global economy shrank by the size of Japan's entire GDP. And the people who caused it, they walked away richer than ever. Zero accountability. The architects escaped. Dick Fuld earned nearly $500 million during his time running Lehman into the ground. After the bankruptcy, he testified before Congress. He blamed rumors. He blamed short sellers. He blamed everyone but himself. And then he walked free. No criminal charges, no jail time, no accountability whatsoever. That's when Americans realized something profound and terrifying. In modern capitalism, catastrophic failure isn't punished, it's insured by taxpayers. The US government launched the TARP program, $700 billion in your tax dollars to buy up toxic assets and prop up failing banks. The Federal Reserve quietly pumped over $16 trillion in emergency loans to the financial system, including to foreign banks. The biggest wealth transfer in modern history, all disguised as saving the economy. Wall Street called it rescuing the system, but what they really saved was themselves. The fake recovery, inflating another bubble. And that's how the post-Lehman world was born. A world where financial markets no longer reflect the real economy. They've replaced it. After 2008, central banks became the economy's life support machine. Interest rates dropped to zero. Quantitative easing flooded the world with cheap money. But that money didn't go to working people. It didn't go to small businesses struggling to survive. It went straight into assets. Stocks, bonds, real estate, commodities, all inflated by artificial liquidity pumped in by central banks. The result was the biggest fake recovery in history. The stock market doubled, wages stayed flat, billionaires doubled their wealth, households drowned in debt, inequality exploded like never before. Lehman Brothers was supposed to be the wake-up call, the lesson, the warning. Instead, it became the playbook. Because once the government proved it would rescue the system at any cost, risk lost all meaning. Investors stopped asking, "What if this fails?" and started asking, "How big will the bailout be next time?" The addiction, same drug, bigger dose. Every bubble since has followed the exact same pattern. Tech bubble bursts, the Fed cuts rates. Housing bubble bursts, the Fed prints money. Pandemic hits, central banks create trillions in liquidity overnight. Markets didn't just recover, they learned that reality is optional, that consequences are for poor people. But cheap money has a side effect: addiction. The global economy now depends on debt, the way an addict depends on their next fix. Each injection calms the pain temporarily, but it weakens the body underneath. By 2020, global debt had surpassed $280 trillion. That's 3 times the entire world's annual economic output. And the same patterns that triggered 2008, leverage, wild speculation, blind faith, are everywhere again. Only this time, they're bigger. Crypto promised freedom from banks and delivered chaos and scams. Meme stocks turned the market into a casino. Tech company valuations hit insane levels, completely disconnected from actual profits. Real estate prices soared again, fueled by record low interest rates. Every time the system shakes, the same medicine gets applied. Print money, borrow more, inflate everything, repeat. The real bubble: institutionalized failure. But here's the ugly truth. Every rescue digs the hole for the next collapse. Every bailout inflates the next bubble. The illusion of control has replaced actual stability. The financial system learned how to survive collapse, but only by spreading the pain to everyone else. Banks can fail, countries can default, but the machine always gets refueled. That's the hidden legacy of Lehman Brothers, the institutionalization of failure. We call it capitalism, but it's not. It's socialism for the rich, profits privatized for the powerful few, losses dumped on the public. And this model doesn't just shape economics, it shapes politics. Because once money becomes infinite for the powerful, democracy becomes negotiable. The system bends towards whoever can survive the crash and come out stronger. That's why Lehman still matters today, not as a dead company, but as a mirror showing us the truth. It revealed what happens when debt becomes destiny, when wealth isn't measured by what you build, but how much you can borrow and get away with. 15 years later, living in the illusion. 15 years later, we live in a world specifically designed to prevent another Lehman, not by fixing what broke, but by making sure nothing is allowed to break again, no matter how rotten it gets underneath. The financial system is now so interconnected, so over-leveraged, that it can't be corrected without imploding everything. So central banks play God. They print, they pause, they raise rates, they rescue, and the rest of us just hold our breath and hope. But here's the truth nobody wants to say out loud. Every illusion of safety comes with a countdown timer. The next collapse won't look like 2008. It won't start with a bank run. It'll start with a confidence run. The moment when people stop believing the system is under control, when the spell breaks. Because in the end, money is just trust. Numbers on a screen backed by collective belief. And trust, once it's shattered, can't be bailed out, not by any amount of printed money. The mask slipped what we really learned. The fall of Lehman Brothers wasn't just one firm's failure. It was the moment the mask slipped off the whole system. We saw how fragile the free market really is, how democracy bows down when finance panics, how power never wastes a good crisis. It just restructures everything around itself and comes out stronger. And what did we actually learn from all of this? That in modern finance, every rescue creates the seeds of its own collapse. Every solution writes the script for the next disaster. The 2008 crash was the line we crossed, from real capitalism to pure simulation. Now, financial markets don't measure reality, they manufacture it. They create it out of thin air and force everyone to play along. That's why understanding what happened to Lehman isn't ancient history. It's not nostalgia. It's survival information. Because everything that happened since, every market move, every bailout, every bubble, has been built on that exact blueprint. The illusion of control,
The addiction to cheap credit,
and the quiet understanding that someone else will always clean up the mess, that you and I will always pay the bill. And that illusion, not subprime mortgages, not failed regulation, not one arrogant CEO, that's the real bubble, and it still hasn't popped. Lehman Brothers didn't just collapse, it exposed how the system really works, and more importantly, who it actually works for. Spoiler alert, it's not you. If this opened your eyes to something new, hit that subscribe button, because history has all the answers. We just need to pay attention. The question is, will we learn the lesson this time, or are we doomed to repeat it, only bigger?